Welcome and thank you for joining our conversation and data walk on the last 2 decades of the labor market. I'll be your moderator for this conversation. My name is Nye Hodge. I'm a policy specialist on the Community and Economic Development team at the Federal Reserve Bank of Atlanta. I'm joined this afternoon by my esteemed co-authors, Carl Van Horn and Stuart Andreessen. Carl is a distinguished professor of public policy and director at the John J. Hildreth Center for Workforce Development at Rutgers University, which is also my alma mater, Go Knights. And Stu is the executive director at the Burning Glass Institute and is also my former boss from his time at the Fed. First and foremost, the audience, we'd like to thank you all for joining us. Calendars are busy and there is no shortage of webinars or content that you could have joined, but you chose to join us, and for that, we are really grateful. We have an illuminating and I hope thought-provoking and motivating conversation lined up for you all. The Labor Market Then and Now series is a retrospective exploration of labor market, workforce, occupational, educational trends to tell a story of the American worker on the average through data. We compiled and analyzed heaps of data that uncover where outcomes have improved for workers, where they've stagnated, and areas of opportunity. We hope this series is informative for workforce practitioners, policymakers, business leaders, and others who are looking to double down in areas where the trends show positive signs and continue as change agents in areas where the trends are stagnant or regressive. So this series was launched in 3 parts. Part 1 is titled Key Trends and Transformations in the 21st Century Labor Market, and it focuses on big labor market trends. Think earnings, labor force participation, unemployment rate, and the like. Part 2 is called The Evolution of Key Worker Support Systems in the 21st Century, and it focuses on policy interventions over the last 2 decades and how those have helped shape the experience for workers. Part 3 is titled The Changing Landscape of Education Outcomes and Funding in the 21st Century. And that iteration focuses on higher education. And it's also the last and final installment of our 3-part series and will be the primary focus of our discussion today. So in a few moments, I'll be dropping the links to all 3 of those publications into the chat. You can feel free to browse them as we have this discussion. Feel free to use them to help generate questions, but of course, they're going to be available to you at your convenience later on as well. Now, we wish we could fit all of the data and all of the metrics and all of the crosscuts into this 3-part series, but of course that wasn't possible. So we featured data we thought gives the best macro picture of the labor market. You'll find that each publication is a story told primarily through data visualizations. The series features 41 graphics. Data are both aggregated and disaggregated by demographic. These publications are open to the public. They are a public resource, and you all are more than welcome to use the charts and tables and insights for your own work. And the citation details are available in the publication for your convenience. All right, so before we continue, some quick housekeeping. We'd love to engage with you all throughout this discussion. You can drop your written questions into the chat at any time, and we'll do our best to loop you into the conversation. If you include your name and organization, we'll try to respond in ways that are relevant and specific to your line of work, whether you're a practitioner, an academic, a researcher, policymaker, et cetera. But if you prefer to remain anonymous, that's totally fine too. Okay, so I've said a mouthful, so it's time to hear from Carl and Stu. But before we begin, I do have to read our Fed disclaimer. The views expressed today are our own, respectively, and are not necessarily the views of the Federal Reserve Bank of Atlanta or the Federal Reserve System. So with that, Carl and Stu, it was a pleasure working with you all on this 3-part series. Thank you for looping me in on this. I had learned a lot working with you all, and I think our readers have learned a lot reading the series. I'll have you introduce yourselves to the audience, but Carl, as you introduce yourself, tell us how this series came about. And Stu, when you introduce yourself, tell us more about why it's important to track trends like this over time.
Thank you, Nye, and thank you for leading this project, and thanks to the Federal Reserve Bank for including us in this project. Um, we started this at the Heldrick Center now 25 years ago, believe it or not, because we felt that there was really an overemphasis on the month-to-month, week-to-week economic data. For example, there's a huge hue and cry every time the unemployment numbers come out every month, people predicting what's going to happen and then saying, oh, it didn't make the predictions. That's fine. I understand why people might want to be interested in that. But the more important question is, how does this go in the long run for people and for the economy? Um, and it tells us the monthly, weekly news cycles do not tell us very much about that. And they don't tell us very much about what policy remedies might make sense. So real progress and change is measured in years and decades, not in months. So that was the fundamental purpose of this. And I think it's important for policymakers, the public, and interested parties to take a broader view of what's improving and what is not improving.
I think that that's exactly right. I want to expand on that a little bit and just like put a couple of things in context. We looked at the first 20 years of this century. Um, that those are moments of profound change. When you look back over a period of that type of time, the the iPhone was invented in the middle of this study, of the years of this study. Obviously much more recently, but if we're to update this in a few years, we'll be looking at the explosion and adoption of generative AI in all types of applications. But it's not just tech change, it's also the way that communities change, it's the way that the country changes. Those things don't happen week to week. And it's really important to think about how you're building towards, moving towards meeting goals like whether people are living the American dream, whether people are able to move to the middle class, and whether people are able to look at economic mobility. And those are things that don't change shortly. Which is why I actually think it's really, really important that you continue to try to study these things. We need data sets that continue to collect information on what's happening in the labor market so that we can understand how changes in the economy, how changes in the country are having effects on that, where they're creating new opportunities, where technology is creating new jobs. It's also important, though, to have long-term perspective so that you have benchmarks to understand when there are big policy experiments and new things have changed, you can start to see whether those work. Looking at long-term population trends tells us whether or not policy experiments and new and different approaches to practice and education are actually having long-term effects. One of the things that I think is really cool as we look at this is we actually do see some of those, and we'll obviously get to those in a couple of minutes, but it's absolutely critical that we continue to collect information that allows us to take these long-term views to understand what's happening with the population, to understand how the labor market's changing and how all of the dynamics that we looked at are interacting with each other to create economic mobility.
Absolutely. As you all reflect on all the data that we parsed throughout this process of putting these three pieces together, what trend stood out to you all the most as the most striking?
Well, I'll start there. And I want to talk about two trends. One is something that didn't change, and the other is one that did change. Um, so the one that did not change is the persistence of the benefit of a college degree, not enrollment, but completion. And this is both about changes in the workforce on the demand side, but also the behavior of individuals in colleges and universities and the government. Um, let's start with individuals. There's continued to be a very strong interest in people going on for post-secondary education. Um, high schools promote this as part of the way they evaluate themselves and speak to the residents of their communities. colleges and universities have become very eager to increase enrollments. And part of that is because overall the population of college going students is declining because the baby boom echo is over and people are having fewer children. So there's fewer customers. So they've increased their marketing efforts, their recruitment efforts to bring people into colleges and universities and make them more welcoming. And governments have also increased, both at the federal and the state level, strategies for providing financial assistance to students to entice them to go to college. So that is persisting, as you showed in the chart there. And again, I want to emphasize it's about not just attending, but completing. And of course, that's a problem. People don't complete at a high rate in many cases. And so what they're left with is some college, but often a lot of debt, and not a lot of advance in their earnings capacity. I think, Stuart, you wanted to comment on that as well, right?
Yeah, oh, yeah, sorry. I think that, you know, as we look at this, we want to kind of unpack why, you know, let's say the middle educational levels, a high school diploma and some college, feel relatively stagnant. It's really important to take these types of things into perspective as we think about the new kind of innovative models that are coming to education. There's still kind of clear evidence that a college degree is seeing big increases in the premium and kind of persistent advantages. Um, Higher ed's obviously facing a lot of challenges. You know, if you then think about population trends, there are going to be less traditional students. So it means we have to start to think about how we're serving other less traditional, maybe adult education students that are going to college, potentially returning and moving from a some college learner to a college degree. We want to make sure that those types of benefits continue to persist, but that we're also making education possible for workers to be able to do that.
And Carl, I know you want to touch on unemployment spells by demographic.
Yeah, no, this is the one that has changed, right? And if you look at this chart, basically, this is the average number of weeks individuals spend on the unemployment roll, right? So, and you know, we can explain this in part if you go back to 2000. You know, we had a strong economy back then, low unemployment rates, et cetera. And then the Great Recession happens in the middle of this chart, and it goes way up to 35 average, you know, weeks unemployed. But if you see today, 2022, or almost today, 2022, you know, the end of the pandemic, we're still at 21 weeks for all workers. And basically what's happened is it's taking longer for people to get back in the workplace. And this, it also took a very long time to recover from the Great Recession, and was taking a long time to recover, if you will, from the pandemic. And this is very important because it means that our support systems are under strain, whether it's unemployment insurance or other supports for people who are unemployed as families face financial difficulties. It also means, I think, mismatches in what individuals are bringing to the labor market versus what employers are interested in hiring. And longer spells of unemployment also lead to many other negative impacts on people's health, on their ability to maintain proper housing, et cetera, et cetera. So this is a long-term trend. It's not showing signs of improvement. And the interesting thing is our underlying support systems are pretty similar to what they were before. And if anything, have become less generous, certainly on the unemployment insurance side. So this is something we need to think about as a society. How do we support these people as they're unemployed to get back into the labor market, to gain the skills they need to be successful, and for that matter, even learn the techniques to be successful to look for work.
And I'll just add in part two of the series, we tease out how um, unemployment insurance during the pandemic really supported workers as they were losing their jobs due to the pandemic. And so going through that section, I think will really help readers tease out what you're explaining here, Carl.
Yeah, I think even on those trends, you know, we saw much greater eligibility. This is one of those kind of big scale policy experiments. Now, this is something that's now over in almost all states, and certainly the federal supports that extended unemployment insurance are gone. But when we looked at the overall eligibility as well as the payment rates of unemployment insurance, those were very different. There were many more workers that were eligible. So people that were finding themselves in something like the pandemic, able to navigate a new job search in different ways. Those make big differences. Now, were they the right question, or the right strategies or not? Those are things that kind of then require some testing. But that's what a lot of this analysis should be about, and kind of even deeper analysis and place-based analysis, state level analysis, the type of stuff that the Heldrich Center does is looking at how did workers then reattach to the labor market? Were they able to find good matches? What were then their kind of overall outcomes? One of the things that's shown from both the Great Recession as well as the pandemic recession is that those extensions tended to help job match. Yes, people stayed unemployed longer, but they were able to get a little bit closer to a job that was similar to the one that they had before and paid similarly to the one that they had before. Um, those are certainly policy choices, and they come with costs to get there.
Mhm.
And we also know, just one other point, is that the longer people remain unemployed, the more their skills erode and the more difficult it is for them to get back in the labor market, because often employers then stigmatize them because, well, if they're unemployed for a long period of time, there must be something wrong with them. Even though the labor market is very bad at that moment, they have a tendency to not always, but often avoid hiring people with long-term spells of unemployment. In a sense, essentially shifting the blame onto the worker rather than thinking about the macroeconomic impacts of that experience.
And to that point, Carl, even as we think about the new automated ways in which HR departments are going through resumes these days, if your resume has a gap of 6 months or more, the automated system won't even allow your resume to go through to a person, right? And so these are real challenges as we think about even how automation and AI are affecting labor market, people's ability to get a job or even be considered for an interview. As we talk about policy disruptions, Stu, in our pre-conversation, you mentioned that you wanted to touch on this chart here as something that really stood out to you as well.
Yeah, you know, this to me is another one. There's a lot of program evaluation work that'll show us whether a program's been effective at connecting individuals to certain outcomes and whether that happened or not. Um, I've always been interested in whether we see population level changes around policies. So if we think about, you know, are we able to actually start to tie changes back to certain interventions, and do they scale? It's one thing if we're reaching dozens or hundreds of people. It's very, very meaningful when you start to see actual population level changes. Now, I also wanted to bring this one up because I think it's a very hopeful slide. At the turn of the century, 14, 15, even 16% of people um, had no health insurance, were uninsured. Because of policy changes in the ACCA, um, we've not reached everyone having insurance, but we've significantly reduced the number of uninsured workers in the country, which is really meaningful. You know, when you think about this in terms of the overall population, it's tens of millions of people that are now protected. And then what does that mean as you're a worker? It means that you're able to get health care for yourself and stay ready and able to be on the job. It means that your children are able to be healthy and in school and learning. These are the types of things that provide resilience that allow people to be available for work, to be available for education, and start to really drive both growth and mobility.
in part 3 of our series, we're going to get back to this summarized chart here that looks at earnings by educational attainment. So in part 3 of our series, we actually explored earnings data by education, and we revealed, as this chart shows, as this table shows, from 2000 to 2020, inflation-adjusted median earnings for workers without a high school diploma, as the audience sees here, I just want to call these numbers out, right? Because I think they're very staggering numbers, right? Increased by $4,052 for workers with no high school diploma. For workers with some college credits or an associate's degree, it actually decreased by $1,132. And for workers with college degree, inflation-adjusted median earnings increased by a staggering $16,138. Very stark difference for talent. Oops, looks like I lost the slide here. There we go. A very stark difference for talent with and without a 4-year college degree. And to further draw out this comparison, in 2000, workers without a college degree earned $54 for every $100 workers with a college degree earned. And by 2020, that actually decreased to $46. Carl, I'm going to come back to you here. What are hiring practices that help explain this divergence? Let's go into it a little bit deeper.
Yeah, I think there's a couple of things going on. One is the change of the economy. What is given premium in the workplace, more digital and high-tech skills, which often are most likely earned with a college degree or beyond. And I think that the other point is perhaps somewhat more cultural, which is that we know lots of studies of human resource hiring practices. People hire people like themselves. In other words, they feel more comfortable hiring a person that looks like them or has had the same experiences as them. It's also easier to locate and vet applicants who have a college degree, right? Because there's a lot more data points from, we alluded to the HR offices before. We can look at indications of at least proxies really for performance, whether it's a GPA, grade point average, activities that people have been involved in. Sometimes grit is a term that's been applied, that they've been able to stick to it and stay with it despite some of the challenges. A lot of internships that people can have access to in colleges and universities that obviously a person with a high school diploma or less doesn't have those opportunities. So in a sense, what college provides for employers is often a testing board. They can test people without paying anything, right? So they haven't paid anything, except maybe a little bit of an internship, but they've let the college and university do that, and the individual prepare for that opportunity. And then they have that opportunity then onboard people and socialize them to their own companies. And often the last point I make is networking is obviously important in the hiring process. So what does a college or university provide you? It provides networking to a group of alumni and other people, professors, fellow students who may help you down the road. And we've also seen, by the way, a surge in graduate school, especially during periods of high unemployment. People will, you might say, shelter in place. They go to graduate school, gain some more skills, and then go back into the labor market after a pause. So I think all of these things continue to help explain why both the nature of work, but also the cultural preferences and experiences that people have with an advanced degree.
So we actually have a question here from the audience, and I'm going to tie it in to the next question here for Stu. So Stu, the question from the audience is about degree inflation. You are at the Burning Glass Institute. The Burning Glass Institute has access to real-time historical job postings data to the tune of 2.5 billion historical and current job ads. So I'm going to make this a two-part question, Stu. What
Sure.
types of occupations and skills are the labor market putting an additional value on? And how do degree requirements factor in? And
Yeah.
tying in our audience question, are there any jobs that are calling for a college degree but don't actually require college skills, right? Getting at that degree inflation issue that folks are perceiving in the labor market.
Yeah, I will say first off, this is the type of analysis that we do pretty regularly because these are really important questions. You know, how do people get into certain jobs? We use the job postings data from Lightcast. They're a provider of that kind of big, huge, really rich data on what's happening in the labor market. By parsing out postings, you build a kind of a profile, and one of those things in there is what's an employer asking for a job? You know, does it say it's a bachelor's degree required? Does it say we're willing to take someone with a non-degree credential? You know, when you do that, you can also then look at the skills that are in demand and kind of figure out, you know, do a little bit of work on saying, oh, this is a job that normally pays this, or the employer said that they'll pay that. Here are the skills that are in it. Here are ones that are typically associated with a degree. The other thing that we spend a lot of time doing is actually starting to then say, well, what's reality? Because we can certainly look at skills that people have and say, oh, you know, they should be able to do that job. But it's required typically this may be a degree inflation one, or maybe it's not. Um, but we've built a data set of career profiles and career histories. So if you think that postings tell us what employers are asking for, we've also built this data set so that we can understand the lived experience of workers. We use that to do occupational analysis just to say, is this a job where there's a meaningful number of people without degrees actually working in it? We in a lot of the analysis that we've done in things like the American Opportunity Index, we've defined a job that doesn't require a college degree as one where roughly 1 out of 3 workers in that job doesn't have a degree. Now, you know, any job, there's going to be people with degrees and, you know, people without because people are different. People's backgrounds are different. But we don't want to say, hey, you can't be a project manager because the BLS says that it requires a degree and most people require a degree. But we thought if, you know, 1 out of 3 people had found their way into that job without a degree, it's a realistic pathway. We think that's really important to sit next to skills analysis because you want to be telling people that these are things that have actually happened. Certainly, then you can find some instances where you're going to say, here's a job where we think that it all works and we need to remove some barriers. But there are a lot of those, and you can do that in a lot of different ways. I would also encourage people that if you're not going to be getting into kind of some of bigger data analysis, start with something like the Occupational Outlook Handbook, which will say, if you're interested in a certain job, here's the typical entry-level education and the experience and the context of that job. You can look in your community and start to say, you know, nationally, we've done a survey and said that carpenters have training, but don't require a college degree. Why are we seeing a lot of college degree carpenters? And you can do a qualitative version of that. It's obviously harder to scale in mass, but you know, there are resources that allow you to do that kind of broadly publicly available as the Occupational Outlook Handbook, which gives a baseline of national kind of typical entry level educational expectations and experience expectations for occupations.
I think one of the probably low-hanging fruit examples, if you will, of an occupation that employers call for a college degree, but doesn't necessarily require a college degree, I would say, are coders and programmers, right? We know that there are a ton of online programs that teach folks how to code, how to even do data analysis, right? We know there are employers who overwhelmingly do hire talent who got these credentials online versus at a university, right? And so it really does come down to sometimes employer expectation, right? Some employers are going to just require that college degree while others don't. And sometimes it also comes down to what employers are able to pay, right? The reality is, as we saw on the chart, if a worker is coming in with that college degree, they're going to demand a higher premium. And sometimes smaller businesses are more willing to take a chance on someone who does not have that degree. One, because they might not have the ability to pay that higher premium that a larger company might be able to pay, and so sometimes the ability of an employer to pay salary can have an effect on whether or not the employer is going to request that college degree.
The,
As we talk about, oh, sorry, go ahead, Stu.
I just want to add one thing on that as we think about kind of pathways into jobs for degreed and non-degreed workers. Getting a job is a short-term experience. Having a career is a long-term experience. And I think a relatively unanswered question, but critically important, is what happens to workers in those jobs. Say that we're looking at those middle skill jobs where sometimes there's someone the coders that you're talking about. Is the career experience different for the worker that has a degree versus the one that doesn't, that's been skilled through alternative routes? Are there ways that we can actually start to then ensure that people aren't then hitting kind of a second level glass ceiling or finding themselves unable to get a promotion into management because they don't have a degree? We can again work to remove the barriers that are there, but I actually think that we've done a lot to explore who can get into a certain job, but we then don't think about the longer term mobility pathways for people either with or without degrees. It's something we're really interested in understanding more because we think that that's like kind of the next level. How do you take the second step? What's the second step in a career depending on your educational background is really important.
Absolutely. We're going to pivot here to an audience question. We really appreciate the questions that are trickling in here. I'm going to take this question because it relates to something that we spoke to a little bit earlier. The question here is, why do you think workers without a college degree spend less time searching for a job compared to workers with a college degree? Could it be that one type of worker is more willing, is one more willing to take on lower skill roles? Is it competition in the market? What do you think makes these trends? What do you think of these trends in the future? Will they get worse?
Well,
So basically, the question here. Oh, you got it.
no, go ahead, go ahead, Guy.
No, you got it. I was just gonna clarify the question here. So, looking at workers, we've talked about this in, I believe it's part one of this series, if I remember correctly. Looking at workers without a college degree versus workers with a college degree, it appears the data show that workers without a college degree are spend less time unemployed compared to workers compared to workers with a college degree. Do you all see that trend changing over time as we think about how the labor market is being impacted by new technologies, and just the state of the labor market post-pandemic in general?
Well, I make a comment. I think what we see, and this echoes part of what Stuart was talking about, which is it's harder to get a career than it used to be because of a couple of reasons. One is that the skills change, right, more rapidly than they used to, right? So if you don't have support within the firm you're in, or the firm can't provide the support, you're going to have to go somewhere else to get those skills. So for example, you could be in a small, medium-sized business. They're doing fine, but they don't have any excess capital, if you will, to really support their workers to upgrade as the market changes. So what's that person going to do? They're going to have to go somewhere else, to a place that actually has that kind of ability to really invest in the worker, right? And again, small and medium-sized businesses don't have the margins to do that investment, right? So this is not a blame issue. It's just they don't have the capacity to do it, right? So again, that's why, we've talked about this for many, many years. How do we provide incentives and support in a policy environment for people to upgrade their skills if they're not in a company that is doing that, or they're out of work, right? And we spend a very small money on that as a society, right? And that's not true in other countries, but it's true in this country. We are very much, let the worker figure it out, right? So again, I think that's why a lot of times people thinking about their careers, they're looking for a place where they can get into a stream where they can actually be there for a long period of time and have a regular job for many years and move up the ladder because they've been given the training opportunities.
I echo everything that Carl said on that. I also think that there's also just the pressure. You know, if we think back to that earnings premium, you want to find a right match if you've got a college degree, and if you don't, you've also just likely had less earnings, and reattaching to work is really important to do really quickly.
I want to continue on this note of talking about earnings. I'm going to pull up another graphic here. And so in part one of the series, we also looked at earnings by demographic. We looked at the gender pay gap, for example. And what we saw is that the gender pay gap narrowed. In 2000, female workers earned $76 for every $100 males earned. By 2022, it narrowed to $83 for every $100. And over the same period, the proportion of females in the labor market with a college degree increased by 17 percentage points. In fact, it flipped, right? In 2000, 43% of females in the labor market, in the labor force, had no college experience. And by 2020, 43, in fact, had achieved a 4-year degree. And so, Stu, coming to you here, what might be some of the drivers of these change? For example, how might occupational sorting, for example, or wage transparency or other factors be at play here to explain uh, the gender pay gap narrowing, and also the rapid rate at which females are achieving higher education and entering the labor market?
Yeah, yeah. I mean, this is the type of trend that you look back at. If we were to say do the then and now between the 70s, 60s and 70s and the current day, I mean, you can see kind of actual kind of large scale population changes where women entered the labor force in much more significant rates. We moved to many more working women or two income households in many cases. Um, as we see the trends today, we know that women are graduating college at higher rates, they're entering college at higher rates. Um, the wage gap is still real. It's closed significantly. You know, if we think about it on a percentage basis, it's quite a significant closure of the pay gap. In absolute terms, it's still, you know, very, very real. I think that there's a high chance that that's related to gendered work and occupational sorting. Women find themselves in care work. They still take on many of the career penalties related to leaving the labor force to care for young children. Um, these are the types of trends, though. Like, you know, as you look at the kind of the trajectories on these, it'll be interesting to see whether that's true or not. And certainly in the last couple of years, concerns about men without work and men leaving the labor force, the development of young boys is really a growing concern. It's not showing up in the wage gap, but we may see something different. The pandemic also brought significant changes, which make me believe that there's a chance that the future looks different. The growth of remote work potentially opens up doors for women to have much shorter, smaller maternity leaves or care leaves. These are things that could really change it. There's also been exponential growth in paternity leave. So we're also seeing something that's been on the table for a long time, which is equity in the use of parental leave, partly to help eliminate the penalties that women face in the labor market. So to me, this is one of the ones that tells you that there's something on the radar that we need to think about. If we're to repeat this in 2030, I'm really interested to see what the trends show.
We spent quite a bit of time talking about earnings and educational attainment. So I'm going to advance us a little bit to talk about, let's see, one second here, getting my questions in order. Talk about the tuition rates, right? Here we go here. All right. Carl, going to come to you with this question here as a university professor. So we've touched on, like I said, earnings and educational attainment. What we've seen over the last 2 decades of the labor market is an increase in the cost of higher education. And we all know that that has happened. But in the data, what we're seeing is that over the first decade at four-year public colleges, we saw an increase of 37% in the average annual cost of higher education of tuition. Stayed steady over the second decade. At private, not-for-profit institutions, we saw a increase across all 3 decades. And at private for-profit, we see an increase over the first decade, then a decrease. What comes to mind when you see these results?
Yeah, I think that this has to do with the constraints that public, or the opportunities that public institutions have, and the constraints they face with legislatures and their other constituents, right? They're saying, they don't have the same freedom of movement of pricing that the private institutions have, right? So they have to go before legislatures, and they're asking for support every year. And yes, they're raising tuition, but there's a, if you will, a political cap, a political influence on their decisions there. And the way in which they can manage their finances is by increasing enrollment. So they can just have larger classes, they can do more remote learning, and so they can balance their books in a way that a private institution can. A private institution, many of them do not have a significant endowment, right? So we're not talking about the Ivy League institutions. Most private institutions do not have a big endowment. They also have limited resources to build more buildings and so on. So they can't actually handle their financial situation by surging enrollment. What they have to do is charge more. They have to charge a premium. And so what they do is they charge a premium that makes people believe that it's worth it. And maybe it is. The old saying is Chevy can get you from point A to B, and so can a BMW, but the BMW costs a lot more money. So that's the proposition they're really marketing, if you will. On the other hand, what's going on is a lot of private institutions are facing existential crises because they don't have an endowment or a significant endowment, and their price tag is beginning to pinch. It's just, is it really worth it to pay $60,000 or $75,000 to go to a small private? I'm not commenting on that. I'm simply saying it's becoming more difficult for them. So I think overall, especially with the decline in enrollment, the number of potential customers, we're going to see a lot more of those institutions that will be either merged or simply going out of business. Whereas the public institutions, most of them will probably continue to persist because they're being supported by public dollars.
We have a question from the audience here on gig economy, which is a popular topic that comes up a lot. And this is for either one of you. What role is the gig economy? What role is the gig economy and increase in the number of young people becoming entrepreneurs playing in the lower college degree numbers for males specifically?
I don't know that I can answer the second part because I don't know. So I don't know what role it's playing in lower college degree numbers for males. The trend in terms of college participation is actually kind of a longer term one, and there's lots of reasons for it. Some higher proportions of men in the military, and again, kind of gendered career pathways, more men into non-degree fields like manual construction and all those types of things. So I don't know that it doesn't play a role, the entrepreneurial question in the gig economy, but I don't know that I actually know anything about that. I think broadly the gig economy is having some transformative effects on the labor market. I think that there are potentially positive ones. Some that we saw, more workers were working as gig workers and then had access to things like unemployment insurance. But broadly, what does that mean in the gig economy is that there's some democratization of the way that people can earn money and sell their opportunities. The ability to be creative and market yourself through digital platforms like YouTube um, are incredible. They're hard pathways, um, but those are ones that people may not have had before, living outside of entertainment areas like LA or New York. We now have opportunities to do that. And I think that goes in many different categories, but broadly, there are ways that you can connect to markets. Sometimes those platforms are charging a lot of rent to be on them. They are helping to drive down what were otherwise, or drive down the wages of what were otherwise viable careers. There's two sides of every coin on it, I think.
Yeah, I
Do you
agree.
see the
One quick comment. I think that
Mhm.
gig economy, as Stuart pointed out, it does democratize the labor market to some extent. But what we see when we do surveys, people generally they would like to have a regular job with health benefits and a retirement 401k or something, right? So but this may help them build skill sets that get them into that other economy so that they can have a more secure career. So I think the percentage of people who actually want to stay in the gig economy for a long, long time is very small. But it's still a good entry point for people who aren't necessarily successful going the more traditional route.
There was a question earlier about compensation and benefits. Are employers providing, hold on a second. Do you have information about other kinds of compensation and benefits that employers are providing based on earnings that could show, besides earnings, that could show a different picture of economic gain since 2000? Is it possible to derive a dollar value for these non-monetary benefits that could provide a fuller and truer picture of comparison between degree versus non-degree seekers?
Good question. I don't have an answer for.
Yeah, I
Yeah.
mean, there are ways that people monetize the value of benefits. I'm not sure that it's done in mass. There may be a little bit that you can get from some organizations like Just Capital that have looked to capture some of those things and employer practice and what it means for performance. Um, it's really important. My hunch would be that what we would see is wire gaps between degree holders and non-degree holders, just in terms of studies that I know have identified that degree holders tend to get more learning and development investments at organizations, are often in jobs that have more generous benefits packages. So my guess is if it were monetized, it would look like wider pay gaps.
Yeah, for sure. I'll add on. The data show folks with a college degree tend to have better health insurance or even have access to health insurance in general. They have access to retirement benefits, for example. Sometimes they even have access to uh, stock options, right? If you're at a larger, if you're at a larger company. And to Stu's point that he just made, generally when you have most jobs that require a college degree, you're usually not doing routinized work. You're doing very varied work. And so you tend to pick up a lot of skills, right? And you can't even put a dollar value on the skills that you're learning in the job that you're in. And so as you're in a job, you're learning new skills, you become more valuable to the market over time. And your experience in your experience in that role allows you to demand a higher salary if you ever were to leave that job. Add those skills to your resume, you can now demand a higher salary. So it's really there's quite a number of non-monetary benefits that workers with a college degree have compared to workers without a college degree. It would be hard to definitely flesh that out, but some of the things that you can think about as you explore that question further. And as we're talking about fringe benefits, I want to dive into this chart here. Going to share screen again. Talk about retirement benefits. So One of the key worker support systems that we discuss in our series is retirement benefits, and our analysis found more workers have access to retirement benefits today than in the past. In 2005, 60% of workers had access to retirement benefits. By 2020, it increased to 71%. However, participation only increased by 5 percentage points over the same period. Carl, I'm going to come to you first here. Over the last 2 decades, workers have increasingly become more responsible for their own retirement savings. This is part of the observed shift from defined benefits plans to defined contribution plans. Can you describe the difference and the shift from one to the other?
Sure. I mean, there are multiple causes for this shift, and the number one reason is really the decrease in the amount of time that people work for a single firm or business, right? So there's a lot more churn, there's a lot more changing jobs. On the other hand, the increase in defined contributions is a positive trend. So in other words, this was, of course, created 50 years ago, approximately, the opportunity for people to, with employer match, create some portable savings, right, that they could rely upon rather than expect to stay with the same firm, which is the defined benefit system where you would be for 40 or 50 years with US Steel and you'd have a nice pension and retirement as my father did. But there's more precarity in the workforce, and therefore the portable benefit system makes more sense for most people because that's the life they're going to live. And of course, it means that they're going to have to contribute to it and get in the habit of doing that. And depending on which employer they're working with, but they're taking the benefits with them as they go through their path. So I think this is one of those things where it's not confetti time, but it's better than the opposite, right? It's really the fact that there are other methods to secure your retirement, and that more people are taking advantage of them is a really good thing.
And Stu, to you, what might be some future implications of these changes on the retirement system?
One that I think is worth thinking about, and I'm not sure that there's cause or effect on any of this, but just broadly the role that retirement savings are playing with what's a quite aging workforce. So we've got a workforce that is working, living longer. I'm gonna fail to get this statistic exactly correct, but the fastest growing segment of the workforce is the 75 plus worker. Now there's relatively fewer of them, so it's easy to have a high growth rate. But I think that the BLS projected that by 2033, 8% of the workforce was going to be over 75. That's a significant portion. It means a lot of things. Then when you think about the retirement strategies that both employers are offering, as well as the ones that are available through like Social Security. We need to understand that people are living longer, but work lives are very different than they may have been. We want to save towards, and hopefully people have the opportunity that after a long career and when they're in their 60s, they have the option to retire. I'd love to have that myself. But the world's becoming more complex and people are working longer for sure.
Absolutely. So we have about 4 minutes left. What are the challenges and areas of opportunity that stood out most as we went through this series?
Well, I'll start. I mean, I think that I wanted to come back to where we started in a way, which is that the purpose of this is really to help provide policymakers and other leaders in business and labor and nonprofit organizations a better understanding of what some of the implications are of the long-term changes in the labor market, because society moves faster than policy changes, right? And a lot, especially in the last 20 some years, we've had multiple recessions, including one of the worst recessions in 50 years. We've had the worst pandemic, obviously, in anybody's lifetime. And we also have institutions struggling to meet those moments. So I think the most important takeaway really is we need to be thinking about both the positive and negative implications of a changing economy and come up with different strategies. One just simple example. We do not support enough in-work training for people, either in companies or as a society. Say that's on their own. Well, that means we'll have a less productive society if we simply rely upon that concept. We have to think about helping people improve their skills so that the economy is more productive and they are more successful. But again, that's just one example. But I think these changes that we've identified here raise many questions for our society that to help it continue to be successful and the people who live in our society to be successful.
And Stu, I'll ask you, what do you find most promising?
As we look back at this, I think that there's lots of different ways, and the future is going to bring many more to pull people into what's really important, the American dream, to connect people to work that's going to allow them to make meaning in their lives, to support their families, and we can work to make the economy inclusive. We can make the economy one that's resilient for people that face challenges in the labor market. And there's evidence of that. There's evidence of major scale opportunity to do these things, which is incredible. To me, that's really hopeful. I think that as we look back over the last 20 years, maybe some of the policies that we made are the right choices and some were not. But we have the opportunity to support people's economic mobility. We have the opportunity to support national growth through the actions that we take. We can then measure them, figure out where our priorities are going in the future. And to me, that's really powerful. It means that we're not, as a society, stuck with outside forces driving what happens to us. We get to choose what we are as a society, and we can measure and manage against that.
As someone who is steeped in the data, crunching the numbers, it was very sobering to see how for example, earnings go up and down, right? But over the long term, they trend upward. And so we live these trends every day. We experience them. We experience them personally. We experience them professionally. We hear all the anecdotes. It's one thing, but it's another thing to see the trend in the actual data, right? See what it actually looks like. It reveals potential red flags of the work that still needs to be done. But importantly, it also is a showcase of the progress that needs to be made. And so I'll be looking forward to recapping the next decade of the labor market. And so we are just at 3 o'clock. I want to thank everyone who joined the conversation. We got a ton of questions in the chat. Unfortunately, we could not get to all the questions, but I hope you guys found this conversation very productive and useful. All 3 parts of the series are in the chat, and they're online on the Federal Reserve Bank of Atlanta's website. Feel free to contact us, reach out to us with more questions. We're so glad you joined us today. Have a great rest of the day, everyone.